Welcome to the MoneyShow.com video network. My guest today is Ken Tower. Welcome, Ken.
Thanks, Tom.
Well, you use a technique that was popular many, many years ago and still used by a select few, and called point and figure. Tell me about it, and if maybe you can explain it to our viewers.
All right. Point and figure charting is the oldest form of charting here in the United States. It dates back to 1870s or something like that. The total difference, I should say, it's a totally different technique for measuring prices because it does not focus on volume and it does not focus on time. So all the charts we look at, weekly charts, daily charts, whether they're candlestick, line, bar, whatever, they're all time on the horizontal scale. Point and figure charts only track price changes, which means that they are intimately tied to volatility. So this kind of market where the VIX has gone crazy and the market can swing 10% in a day easy, that kind of volatility is so difficult to handle on a time-based chart. On a market volatility-based point and figure chart, boom, you've got a chart that essentially grows very fast. So a support or resistance area that might take weeks to form on a bar chart in a very volatile market like this will form in days on a point and figure chart. Intraday charts work as well. Many of the same things that you do on a regular, what you'd consider a regular chart, trend lines, moving averages, all sorts of different indicators you can also apply to a point and figure chart. It's just that they move differently because they're just following price action, jumps up and down in price rather than the passage of the clock.
And they're based on the close, right? So that's the intraday volatility is, if not, you're looking at intraday charts?
Ideally, you capture all those intraday moves. The ideal point and figure chart price stream would be the smallest increments you can find. I guess the ideal would be a tick data chart. Now, tick data, even in today's time of fast processors and fast internet connections, is too large to store a long history. So drop down from there. 1 minute data slices, people call them 1 minute bars, 5 minute bars. The more fine you can slice it, the more of that volatility you can capture, and the more accurate your chart will be. So if you only use daily data, for example, a lot of 3-box reversal charts, that's the most popular version. I like the 1-box reversal. I like the original point and figure method. If you only have daily data, it's okay for long-term charts, but if you're going to do anything shorter term, you need to start making that data slice. So use the next step would be, of course, 60-minute data slices, and then 30 if you've got them, 15, 10, 5, and as I say, 1 or tick data would be the ideal because you want to capture those intraday swings. When that market goes down 300, up 600, down 300, up 200, you want to see those swings. You don't want to just look at the end of the day data where it says the market was unchanged. That's how you capture that distribution and accumulation, and that's what's going to give you the clues for when you get an upside breakout that's worth following or a downside breakout that's providing some opportunity.
Great. Well, I'm sure you piqued the interest of some of our viewers, Ken. Thank you very much.
Thank you, Tom.
You've been watching the MoneyShow.com video network.